And this extrinsic value is our moneymaker, and here is how to use it to our advantage. But first, hi everyone. If you're diving into the world of option trading, you probably come across terms like ITM and OTM. But what do they actually mean and how do they impact your trading strategy? In today's video, we're going to break down the key difference between ITM, also known as in the money, and OTM or out of the money options. Whether you are a seasoned trader or just getting started, understanding these concepts is crucial for making informed decisions and optimizing your trades. We'll explore what ITM and OTM options are, how they differ, and the pros and cons of each. By the end of this video, you will have a clear grasp of how to use these options to your advantage and when to pick one over the other. So make sure to stick around and let's dive in. ITM versus OTM options. ITM stands for in the money, while OTM stands for out of the money. The main difference between the two is in the money option premium consists of intrinsic value and extrinsic value, while the option premium of out of the money consists of extrinsic value only. In the money and out of the money options are determined by the difference between the strike price relative to the current stock price, and whether it's a call or a put that we're talking about. And this graph here will show you whether each strike will be considered in the money or out of the money based on its position to the stock price. So let's look at the calls first. The strike of 70, 80, and 90 will be considered in the money because the strike price will be lower than the stock price, while a strike price of 110, 120, 130 will be out of the money because the strike price will be higher than the stock price. The puts will be exactly the opposite of the calls. So the 70, 80, and 90 that was in the money for the calls will be considered out of the money for the puts. And the 110, 120, and 130 puts will be in the money because the strike price is higher than the stock price. And finally, the strike price of $100 considered to be at the money because the strike price are equal to the stock price. The option premium is the main difference between the two. The option premium in the case of in the money calls or puts will be consist of intrinsic value plus extrinsic value. Now the formula to calculate the intrinsic value will be different based on the option, whether it was a call or a put. In the case of a call, you will take the stock price minus the strike price, while in the case of the put, you will take the strike price minus the stock price. Again, it's just the opposite of the call. To find the extrinsic value for any option premium, you will take the option premium minus the intrinsic value that we just calculated. It's also worth mentioning that the extrinsic value consists of the time value plus the implied volatility. It's important to understand how the implied volatility will affect the extrinsic value, especially if you plan to play any option trade around earning, because the implied volatility normally will collapse after an earning call after the result will come out. Let's take a quick example on Tesla options and see how we can calculate the option premium, the intrinsic value, and the extrinsic value for calls and puts in the money and out of the money. For this example, we are going to look at the Tesla option that expire on September 20, which is about 55 days from today. The $200 strike price will cost about 28.83 if we want to count how much intrinsic value versus extrinsic value. Because this is a call and the $200 is under the 220, you know that this will have intrinsic value and extrinsic value because it's a call in the money. So we'll take the 220.75 minus the 200, and that will give us 20.75 premium. That is the intrinsic value. And this will give us 20.75 intrinsic value. Now, if we want to find the extrinsic value, we'll take the premium, which is the 28.83, minus the intrinsic value that we just found out, which is 20.75, resulting in 8.08 extrinsic value. This is the time value that we are paying or receiving for playing this option, depending if we are buying or selling this option. Let's quickly jump to the 250 and see what's the difference. This consider out of the money. And because of the 6.68 average option premium is all considered to be extrinsic value. Now, if we jump to the puts and we went to the 200 strike, it will be the reverse compared to the call options. The 200 strike here has an option premium of 7.13. The 7.13 is completely extrinsic value since this option is currently out of the money. Now, if we go to the 250, of course, because it's in the money, it has intrinsic value. And that's why you can see the premium is very big. It's 35.03, meaning it's $3,503 per contract. Let's calculate quickly here the intrinsic value. We'll take the strike price of 250 minus the current stock price of 220.75. That will result in 29.25. That is the intrinsic value for this put option. Now, if we want to find the extrinsic value, we'll take the 35.03 minus the 29.25. And that will result in 5.78 extrinsic value for this put option. Now, that was an example of how to calculate the intrinsic value and extrinsic value for both the call and the puts on Tesla option. It's crucial to understand that, and I'll show you how to utilize that to your advantage. To maximize our win rate when we are playing in the money versus out of the money options, it all depends on what side of the trade we are taking. When we are the option buyer, we actually want to buy in the money. Although in the money option premium are more expensive, they are more likely to be the profitable and winning trade. While when we are the option seller, we want to sell out of the money. So when we are buying the in the money, we are buying the difference between the current stock price and the strike price that we are choosing. That was the intrinsic value, and the intrinsic value is within the option. It does not expire and we don't lose it if the stock price stays the same. We're only paying to play this option, the extrinsic value part of that option premium. And that's why we want to make it as small as possible. So in a lot of cases, when we buy in the money, we'll focus on the delta and we'll try to get 80 to 90 delta, meaning we are buying deep into the money, which will reduce the extrinsic value to a very small amount, comparing that if we bought a 60 or 50 delta. While when we are the option seller and we are selling that option, we want to sell out of the money because all the option premium that we will collect will be extrinsic value. Extrinsic value, that means they are paying all that amount just to play the option. The option by itself does not have value at that time. They are hoping that during the life of that option, the stock price will move significantly, that their out of the money option will become in the money and it will become a profitable trade for them. However, their percentage of winning are much smaller than your percentage of winning. And if you play it correctly, and I will give you a few examples, you may end up winning with them anyway. Even if the stock price moves significantly and the option that you sold that was out of the money became in the money. There are several strategies that will allow you to use the extrinsic value to your advantage. And since out of the money option consist of 100% extrinsic value, playing that option as a seller will give us a huge advantage in these strategies, as well as rolling over. Rolling over a trade is extremely important when that option became in the money, but you don't want it to get exercised on you in case you were the seller. What you are going to do when you roll over, you are going to exchange intrinsic value that you're collecting while selling again extrinsic value. Rolling over like that will give you a huge advantage and will maximize your return. It will become clearer when I show you several examples and how I do my rollover. So let's take a look at Microsoft. I want to show you I have a cover call sold on it for $4.50 right now, while the stock price today is $4.25. Now let me show you the story behind this call for $4.50. So if I went to my spreadsheet, the first time I sold the cover call on Microsoft was on November 30, 2023. And I sold it for 106 days to expiration. So the expiration date was on March 15. It was a call, sell to open. The price at the time was $377. I remember because I had 75 shares on Microsoft. In order to sell a cover call, you need 100 shares. So I went and I bought 25 shares at $377 and sold the cover call for $400. I collected a premium of $11 per share or $1,100 per contract. My average cost is $297, meaning if it's activate on me, it's a great return, and if it's end up expiring out of the money, it will be also great. Since I'm a big believer in Microsoft, I didn't really want it to get activate on me. So on March 15, on the expiration date of the first cover call that I sold, the price was 416, well deep into the money. But here is where the rollover come in and playing with the extrinsic value versus the intrinsic value. So this contract at that point has about $16 extrinsic value per share, or 1600. What I did here is I rolled over for 3 months from March 15 to June 21st, and I sold it at a higher strike price from 400 to 420. This is the 25 purchase for 376.97 per share, and this is the first cover call that I sold. And then if we go here, you will see that I did the rollover on March 15. I bought to close the $400 strike for 16.90 while selling at the same time the 420 for 21.75, resulting in a credit of $485 per contract. So what I did here with this rollover, I basically sold extrinsic value in the return of the intrinsic value between the 400 to 420. And on top of that, I still collected 485. So you can see that the stock price went against me for $16, but I still was able to roll it over to 420 and collecting premium. That is because, again, I sold out of the money while I own the share, which considered in the money. Because in this case, we are just playing one option leg instead of two. On June 20, Microsoft stock price has jumped big time all the way to 445, well above the 420 that I sold before. Again, I had to roll over. This time is a little bit further time. So as you can see, the days that I roll over was 148 from the June 20 or 21st, the one that I was closing, all the way to November 15. I went and I raised the strike price from the 420 to the 450 and collecting a premium at the same time of $550 per contract. Absolutely great. Let's go back to the history and show you. So if I scroll up here, you will see this is the trade that happened in my history. June 20, I bought to close for $22.55 per share, and at the same time I sold the 450 strike on November 15 for $28.05, resulting in a total credit of $550. So again, we are exchanging the extrinsic value, the time value, the implied volatility value in return for the intrinsic value that is currently exists in this option. So using this method, you will able to roll over successfully if the stock price went against you, as long as it doesn't go way deep into the money, and that will make the rollover harder, or you will have to go longer in time. So instead of going 98, I went to 148. You might have to go for a year and a half if you want to keep the option. One place you can clearly see the benefits of selling out of the money and buying in the money is a poor man cover call. A poor man cover call is a two-leg strategies with two different dates. If we scroll down here, you will see that I bought the $15 strike price that expired on January 17, 2025. And at the same time, I sold the $22 strike that expired on August 16. If we open the history, you will see here the details for this trade. What we did here, we used this sell $22 to pay for all the extrinsic value that we paid for the $15 contract that we bought. In this case, we are like playing for free. Robinhood stock price end on August 16 above the $22. If we didn't roll over, which I probably will, but if we didn't roll over, we will collect a $7 per share while we only paid less than $5.34 per share, meaning we are making money. In about 20 days, we'll see where the share price will be. If it was at 22, a little bit above or a little bit below, I probably will do a rollover. As of right now, you can see I can roll over the $22 to $24 just by selling 2 months into the future, the October 18 instead of the August 16. And that will give me a $44 per contract and a possibly $2 more per share or $200 per contract gain, because we no longer selling for 22, we are going to sell for 24. Again, we are exchanging extrinsic value for intrinsic value. The intrinsic value that we're gaining here is the $2 difference. since we raise our strike from the 22 to the 24, where we are selling the time, the 2 month that we are adding on top of our contract. Right now, I wouldn't do this trade because the $22 still have extrinsic value. Actually, because the price is under the 22, meaning all what is left, the $143 per contract, it's all extrinsic value, which I'm looking to collect or collect most of it before our rollover. Similar example you can see here on Tesla. I have one contract. I have opened it on May 31st. I buy for 150. I'm selling for 190. It cost me $29.60. Right now, since the share have went up to 220, it's considered it is in the money. And you can see the value went up to 42.77, meaning I can close right now and collect 44% profit, which is $1,317. Really great. However, I am going to wait and see all the way to September 20, since I'm in a great position right now for waiting. As long as the share price is stay within reasonably close to the 190, even including the 220, I will be able to roll it over. So let me show you here. We'll go to the September 20. We are going to buy the 190, and then I'm probably have to go all the way to January, since currently it's considered deep in the money. And I want to sell for something a little bit bigger than this because I don't want to pay debit. I want to receive credit. So if I went and I rolled over to the 210, you can see I will collect 255 and possibly another $20 because I'm no longer selling for 190. I'm going to sell for 210. Again, extrinsic value versus intrinsic value. It's absolutely amazing. You are basically selling time. I have more option on PLTR. I'm not going to go into details, but you can pause the video and you can take a look at the date and all the details here. Let's go ahead and take a live example on Tesla option and see why it's better to buy in the money and sell out of the money. If we want to create a call debit spread here, we can buy the 170 strike price, which currently has a delta of 89.75. And then at the same time, we can go ahead and sell something above it out of the money. But first, let's go ahead and count how much intrinsic value versus extrinsic value we're paying. So if we bring our calculator and we said 220.75 minus the 175, it has a 45.75 intrinsic value. As you can see, most of it is really intrinsic value. So let's take the option premium, which is 48.78 minus the intrinsic value that we just counted, which is 45.75. And that will result in 3.03 extrinsic value. So now we know the intrinsic value and the extrinsic value on this option premium. So we're only paying to play $3.03 per share, or $303 per contract. That's really great. So if we go ahead and go sell something against it, so if we sell the 250, you can see right away that we collected $668 per contract. That is way above than the $303 that we're paying, meaning we're really right now we're in the profit. If the stock price shares ended up at the same price as right now, which is 220.75, we will be making profit of 365 on our trade. And even if you see the theta here, which is the time decay, this option will lose $13.5 each day, while the option that we bought, we paid for it, we're only going down 9 cents and a half per day. Meaning we are making actually money, few cents, instead of losing money from the time decay, assuming everything else is equal. So here you go. I hope you found this useful. I hope you understand now the benefit of buying in the money while selling out of the money, how the intrinsic value and extrinsic value work in each direction. Understanding how the extrinsic value work versus the intrinsic value will allow you to roll over successfully your options when it goes against you, or selling a cover call that have a high probability of winning and generating income for you while the share price going up and down within a specific range. Using a 2-leg strategy, buying in the money and selling out of the money will make theta your friend instead of your enemy. If you find this video useful, please give it a like, share it with friends and family, leave a comment if you have any question, and consider subscribing to the channel. As always, the information provided in this video is for educational purpose only and should not be construed as a financial advice. Investing involves risk, including the potential loss of principal. Thank you guys, and see you in the next video.